Most people think they've saved enough for retirement, but they forgot about their silent partner who gets paid first, the IRS. Your retirement accounts aren't actually worth what you think they are. The real value depends entirely on which type of account you're pulling from and when. Let's clear something up right now. When you see that balance in your traditional 401k showing $500,000, that's not really your money. Not all of it anyway. Uncle Sam has a claim on a chunk of that, and depending on your situation, it could be 20, 30, or even 40%. That's the part nobody talks about during the accumulation phase, when everyone's obsessed with contribution limits and employer matches. Here's what actually matters. You've got 3 basic buckets where your retirement money lives, and each one gets taxed completely differently. Understanding this isn't just helpful, it determines whether you'll have enough money to do what you want in retirement, or whether you'll be making uncomfortable compromises at 75. The first bucket is your taxable accounts. These are regular brokerage accounts, savings accounts, anything where you've already paid taxes on the money before you invested it. When you pull money from these in retirement, you're only taxed on the gains. If you bought stock for $10,000 and it's now worth $15,000, you're only taxed on that $5,000 gain, and it's usually at the lower capital gains rate. For many retirees, that capital gains rate is 15%, sometimes even 0 if your income is low enough. But here's where it gets interesting. You have control over when you sell and realize those gains. Pulled some money out this year and pushed yourself into a higher bracket. Just don't sell anything next year. This flexibility is powerful, yet most people have the least amount of money in these accounts because they focused everything on tax-deferred retirement accounts during their working years. The second bucket is your tax-deferred accounts, traditional 401s, traditional IRAs, SEP-IRAs, and similar accounts. This is where most Americans have the bulk of their retirement savings. You got a tax deduction when you put the money in, it grew tax-free for decades, and now comes the bill. Every single dollar you withdraw from these accounts gets added to your taxable income. Not just the gains, the entire withdrawal. Pull out $50,000, and you're reporting $50,000 of income on your tax return. It's taxed at your ordinary income rate, the same as when you were earning a paycheck. Depending on your total income, that could mean paying anywhere from 10% to 37% in federal taxes, plus state taxes if you live somewhere that has them. What catches people off guard is how quickly this adds up. You retire at 65, start taking $40,000 a year from your traditional IRA, add in your Social Security benefits, maybe a pension, and suddenly you're in the 22 or 24% tax bracket. That $400,000 IRA you thought would last 10 years, it's really only going to give you about $320,000 after taxes. That's a pretty significant haircut, and there's a ticking time bomb in these accounts that most people don't see coming. At age 73, the IRS forces you to start taking required minimum distributions. You don't get a choice anymore, even if you don't need the money, even if taking it pushes you into a higher tax bracket. You must withdraw a calculated percentage based on your age and account balance. I've seen retirees get blindsided by this. They spent their 60s living modestly, keeping their income low, paying minimal taxes. Then 73 hits, and they're forced to pull out $30,000 or $40,000 they don't need. That extra income makes their Social Security more taxable, increases their Medicare premiums, and might even disqualify them from certain tax credits. It's a cascade of financial consequences from a rule most people forget exists. The third bucket is your tax-free accounts, primarily Roth IRAs and Roth 401s. You paid taxes on this money before you contributed it, so now every withdrawal in retirement is completely tax-free. Not just the contributions, the gains too. Your account doubled in value over 20 years. All of it comes out tax-free. This is the retirement account that actually is worth what the statement says. A $500,000 Roth IRA means you have $500,000 to spend. There's no hidden tax liability lurking in the balance. Even better, Roth accounts have no required minimum distributions during your lifetime. You can let that money grow tax-free for as long as you want and only take it when you actually need it. This gives you incredible control over your retirement income and tax situation. So, why doesn't everyone just use Roth accounts? Because you have to pay the taxes up front. When you're in your peak earning years, paying taxes now at a high rate to avoid taxes later at an unknown rate feels painful. Most people take the immediate tax deduction and worry about the consequences later. But here's what makes this really complicated. The smartest approach isn't putting everything in one bucket. The real strategy involves having money in all three types of accounts because that gives you options when you're actually living in retirement. Let me show you why having this mix creates opportunities that can save you tens of thousands in taxes over your retirement years. Here's how having all three buckets working together completely changes your tax situation in retirement. Let's say you're 68 years old and you need $70,000 to live on this year. If all your money is in tax-deferred accounts, you'd have to withdraw around $90,000 to net $70,000 after taxes. But watch what happens when you have options. You could take $20,000 from your taxable brokerage account where you only pay capital gains tax on the growth portion. Maybe 15% tax on the gains, so you net most of that $20,000. Then pull $30,000 from your traditional IRA, which keeps you in a lower tax bracket since you're not withdrawing the full amount. Finally, grab the remaining $20,000 from your Roth IRA, completely tax-free. Suddenly you're paying maybe $12,000 in total taxes instead of $20,000. Same lifestyle, $8,000 less to the IRS every single year. This gets even more powerful when you factor in those required minimum distributions I mentioned earlier. Let's say you turn 73 and your traditional IRA forces you to withdraw $35,000. You only need $60,000 total to live on. If that's your only account, you're stuck taking the $35,000 whether you want it or not, then you need another $25,000 on top of it. But if you have multiple buckets, you take the required $35,000 from your traditional IRA because you have to, then pull the remaining $25,000 from your Roth. You've satisfied the IRS requirement while keeping your taxable income as low as possible. The flexibility extends to managing those Medicare premium surcharges too. Your Part B and Part D premiums are based on your income from 2 years ago. If you can keep your modified adjusted gross income below certain thresholds by controlling which accounts you tap, you avoid those extra charges entirely. For a married couple, staying under $214,000 in income saves you about $3,000 a year in Medicare premiums. That threshold might sound high, but required minimum distributions from a large traditional IRA can push you over it faster than you'd expect. There's another scenario where this multi-bucket strategy proves its worth. Major one-time expenses. You need a new roof, $40,000. Your kid needs help with a down payment, $30,000. If you're pulling everything from tax-deferred accounts, you're withdrawing way more than you need just to cover the taxes. That $40,000 roof really costs you $52,000 when you factor in the tax hit. But pull it from your Roth. $40,000 out, $40,000 to the roofer. No tax bomb, no pushing yourself into a higher bracket for that year. I've watched people create what I call a tax arbitrage opportunity during the early retirement years before Social Security, and required distributions kick in. You retire at 62. You're living off your taxable accounts and maybe some Roth money, keeping your income low. Your tax bracket drops significantly. This is the perfect time to start converting chunks of your traditional IRA to a Roth. You're paying tax on those conversions, sure, but you're paying it at 12 or 22% instead of the 24 or 32% you would have paid while working. You're essentially moving money from the tax-deferred bucket to the tax-free bucket while the tax cost is on sale. Those conversion years from 62 to 70 can reshape your entire retirement tax picture. Every dollar you convert is one less dollar subject to required minimum distributions later. It's one less dollar pushing up your Medicare premiums at 75. It's one less dollar getting taxed when you don't need the income, but the IRS says you have to take it anyway. People overlook this window, then spend their 70s and 80s kicking themselves for not acting when they had the chance. The taxable brokerage account plays a role most people underestimate too. Yes, you pay taxes on dividends and capital gains each year, but you get to control when you realize those gains. Stock went up 50%? You can hold it forever and never pay tax on that growth until you sell. Compare that to a traditional IRA, where every dollar out is taxed as ordinary income, regardless of whether it came from contributions, dividends, or growth. The taxable account also doesn't have required minimum distributions. You decide when and what to sell based on your actual needs and the current tax landscape. Here's the reality nobody wants to hear, but everyone needs to understand. The government didn't create these different account types out of generosity. They created them to collect tax revenue, either now or later. Your job isn't to avoid taxes completely, because you can't. Your job is to pay the lowest total amount over your entire retirement by being strategic about which bucket you pull from each year. This isn't set it and forget it planning. Tax brackets change. Your income needs fluctuate. Required minimum distributions increase as you age. Medicare thresholds adjust for inflation. The right withdrawal strategy this year might be completely wrong 3 years from now. You need to reassess annually, looking at your projected income, upcoming expenses, and current tax situation. Most people spend decades building these accounts without any real plan for how they'll actually use them in retirement. They save diligently, max out their 401k, maybe open a Roth, build up some savings in a regular investment account. Then they hit retirement and just start pulling money randomly from wherever without considering the tax consequences. That approach costs them thousands every single year. Having money in all 3 buckets only creates opportunity if you actually use them strategically. Otherwise, you've just made your retirement more complicated without getting any of the benefits. The difference between understanding this and ignoring it isn't minor. It's the difference between your money lasting until 90 or running tight at 82. It's whether you're stressed about every withdrawal or confident in your strategy. The accounts are already built. Now you just need to use them right.